Paying taxes is pretty simple while you're working. You choose the right withholding, typically one time. Taxes come out of your paycheck, and unless something unusual happens, you're generally covered. But in retirement, things change. Income becomes more variable, and for the first time, you're fully responsible for making sure the right amount gets paid, and more importantly, paid on time. That's why in this video today, I'm going to walk you through 3 simple IRS rules that can keep you safe from penalties, no matter how unpredictable your retirement income feels. For those that are less familiar with tax payment methods, let's start with a brief overview. In retirement, you can pay taxes in one of 2 ways. The first is estimated tax payments. This is usually a more complicated method and involves writing checks from your savings or taxable account 4 times a year on the IRS schedules. These are a bit more complex and require you to meet strict deadlines and requirements each quarter. The second option is withholdings. You can have taxes withheld directly from your IRA distributions, pensions, and even Social Security. The big advantage here is that withholdings are always considered timely, no matter when during the year that you make them. Timely is a big topic that we'll be discussing as the IRS expects tax payments and what they define as a timely manner. Now, when we look at these 2 methods, withholdings in general are far simpler because, as we mentioned, timing is not a factor with this method. Now, most retirees will use withholdings on a monthly basis, but know that you have a lot of timing control when it comes to withholdings, and this can be a sizable benefit. For instance, you could set withholdings on all of your income to 0, and then wait until the very end of the year, take a single distribution from your IRA in December, and withhold that entire distribution for taxes. Assuming you did all of the tax math properly, the IRS counts withholdings as if taxes were paid evenly throughout the year. Now, why would someone do this? Well, you can earn free interest on those tax dollars throughout the year as you're waiting for that final payment. That flexibility is a huge advantage compared to quarterly estimates. With estimated tax payments, paying the right amount on a specific timeline is paramount. The IRS lays out 4 strict deadlines each year: April, June, September, and then the following January. If you don't pay the right amount by those dates, you risk something called an underpayment penalty, even if you eventually catch up later in the year. Now, after seeing both methods side by side, most retirees will gravitate towards withholdings, and for good reason. They're simpler, more flexible, and often the easiest path. But here's the catch. We've talked in many of our videos about how your withdrawal order matters quite a bit in retirement. For most retirees, it often makes sense to spend from taxable accounts or savings early in retirement. But here's the problem. You can't set withholdings from a taxable account. That means if you're pulling from taxable accounts, generating capital gains, dividends, etc., you need to know how quarterly estimates work. The good news is I'm going to help simplify these complex rules greatly in this video. Now, just 2 quick things before we jump into these rules. First, how do you pay estimated taxes once you know how much you need to pay each quarter? Well, there are 2 methods here. The first is you go directly on the IRS website. There is a pay tab at the top of the screen where you can direct pay from your bank account. Following the prompts will take you to this screen on the left-hand side where you can take care of your payment directly online and get proof of payment in return. The other method is to send a check and a payment voucher like the one you see on the right-hand side of the screen. These vouchers can typically be found online or requested from your tax accountant. Next, I want to quickly touch on the stakes of handling tax payments incorrectly in retirement. These are called underpayment penalties, and they can be surprisingly costly. For example, let's say that you're in retirement doing some Roth conversions, and you decide to pay all of your taxes next April when your tax return is due. The IRS isn't going to like this approach. They expect taxes to be paid as you go, either through withholdings or those quarterly estimates. If you don't, the IRS charges a penalty that works like interest, currently around 7% annually on the amount that you underpaid. Now, depending on the size of your tax bill, this can add up quite quickly. Now, here's the good news. The IRS actually gives you 3 clear rules, what are called safe harbor rules. If you hit any one of these rules, you're automatically protected from underpayment penalties, even if you still owe taxes come April 15th of the following year. I'm going to first give you these rules, and then we'll show some examples to help increase understanding. Rule number 1 is the $1,000 rule. If you owe less than $1,000 when you file, you will have no penalty. Rule number 2 is the 90% rule. As long as you paid in at least 90% of what you ultimately owe for the year, you're covered. And then rule number 3 is the 100 or 110% rule. If your income last year was under $150,000, you are all set if you just pay in 100% of what you owed last year. It doesn't matter if your income this year was $1 million higher. If you covered last year's tax bill on a timely basis, you're golden. If your income last year was $150,000 or higher, this rule adjusts to 110%. Meet that threshold and you're penalty proof. Now, these three guardrails mean that you don't have to predict your future income perfectly. You just need to line up with one of these safe harbor rules. Let's jump into some examples. Last year's income was $90,000 with a $9,000 tax liability. This year's income and taxes will be higher. It doesn't matter how much higher, it just matters that it's higher. Now, in general, our goal with quarterly estimates is to pay the least amount that is required so we can earn that extra interest on our tax dollars. Now, again, we're going to owe those April 15th of the following year. The minimum method in this case would be to use the 100% rule because last year's income was under $150,000. This means that we split last year's taxes into 4 equal parts and pay those at the quarterly deadlines. Now, note, again, we will still owe taxes come April 15th, but we will ensure that we don't owe any underpayment penalties because we are meeting one of these safe harbor rules. Next, we have example number 2 with a fairly similar situation. Here, the income last year was $175,000 and taxes were $20,300. This year's income, let's say due to a big Roth conversion, will be higher. The same general premise as the last rule applies, but instead of the 100% rule, we need to follow the 110% rule because our income last year was over that $150,000 mark. So we take last year's tax liability and multiply it by 1.1. We then split it into 4 equal parts, and that will solve for our quarterly estimate. Again, we will owe more tax come April, but we will avoid those underpayment penalties. Safe harbor rules are quite simple in situations where our taxes this year will be higher than those taxes last year. In these situations, simply follow the 100 or 110% rule. But what about situations where this year's income is going to be lower than last year's? Let's walk through an example. Last year, our tax bill was $20,300, but this year, based on our withdrawal order, we know taxes will be much lower. Let's say $8,500. Now, 2 safe harbor methods may apply here, the 90% rule and the $1,000 rule. With the 90% rule, we need to pay in at least $7,650 this year. With the $1,000 rule, we need to pay in $7,500. Technically, the $1,000 rule gets us to a lower number, but in practice, either method here works. Here's the important distinction. Using the $1,000 rule or the 90% rule requires you to accurately forecast your tax bill for the year. By contrast, the 100 or 110% rule doesn't require any forecasting. It's simply based on last year's tax liability. So as part of this quarterly estimates method, we have to ask ourselves how forecastable this year's taxes will be. On the screen, I have a general framework for how I would think about this. First, I looked at how much quote-unquote forced income we have. This is income we really don't have a choice over taking. Social Security income, RMDs, pension, dividends, and interest. Then at the beginning of the year, we should also know what our withdrawal method will be for that year and whether we are doing any Roth conversions. If we are spending from our taxable account, we should be able to estimate what capital gains will be from selling certain positions. For the majority of retirees, if we look at forced income and our optional income categories, this should be enough where we can get reasonably close to estimating out this year's tax liability. From there, we can quite easily follow the 90% or the $1,000 rule. But lastly, then, we have to ask ourselves if there might be any surprises throughout the year that maybe we aren't initially considering. For instance, if you own a bunch of mutual funds in your taxable account, these mutual funds can often spit out capital gain distributions at the end of the year and lead to higher unexpected income. You might also have unexpected income from things like work payouts, settlements, or even inheritances. These surprises can throw off your forecast and make it harder to rely on the 90% or $1,000 rule with confidence. That's why understanding your own situation is key here. If your income is steady and predictable, driven mostly by Social Security RMDs or planned withdrawals, then the 90% or $1,000 rule can work quite well. But if there's a chance for big unexpected swings, the safer play is often the 100 or 110% rule because it doesn't require you to forecast at all. You just match last year's taxes and you're penalty proof, regardless of what surprises show up. Now, one last wrinkle before we wrap up here. Everything we've covered so far assumes your income is spread fairly evenly throughout the year. But what if you're following something like the 90% rule because you thought your income was going to be predictable, and then a large chunk of income shows up late in the year? The IRS does give you an option here. You can file Form 2210 with your tax return. This form essentially lets you line up your payments with when the income actually arrived. For example, let's say that your mutual funds kicked out a huge year-end capital gain over what you were expecting. By using Form 2210, you can show the IRS that your payments tracked your income even if they weren't perfectly even quarter by quarter. Essentially, you are saying to the IRS, hey, for the first 3 quarters of the year, I paid proper quarterly estimates, but then got a surprise in the 4th quarter. You can show this with that Form 2210 and fix the variable income issue by making a bigger fourth quarter estimate. It's a more complex method and not everyone will need to use it, but it's a helpful backstop if you have uneven or lumpy income and you want to avoid penalties while still using rules like the 90% rule. So to recap, taxes in retirement don't have to feel like a guessing game. The IRS gives us 3 clear rules to stay penalty proof, and depending on how predictable your income is, you can choose the method that makes the most sense for your situation. For those with steady income, the 90% or $1,000 rule can work really well. For those with more variable income or higher income this year, the 100 or 110% rule or even Form 2210 gives you a safer path. The key is understanding your own income mix and planning ahead. If you found this video helpful, let me know in the comments. I'd love to hear if you want me to create more short practical videos like this one. And if you're not already subscribed, hit that button so you don't miss the next strategy video. Thanks for watching, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.